When was the last time you walked into a bank branch? For millions of people, the answer is, I don't remember. That's because the bank of the future isn't a building on Main Street, it's an app on your phone, and the traditional banks are terrified. This is FinBytes. Let's talk about fees. In 2010, the average monthly maintenance fee for a checking account was under $3. Today, it's often $12 or more just to hold your own money. Add in overdraft fees, which earned big banks over $15 billion a year at their peak, and banking starts to feel expensive. Enter the Neobanks. Companies like Chime, Revolut, Monzo, and SoFi looked at this model and said, we can do better. They launched with a simple promise: no monthly fees, no overdraft fees, get paid 2 days early, and do it all from a slick app that actually works. But wait, if they don't charge you fees, how do they stay in business? Are they just burning venture capital cash? Partly, yes, but they also have a different revenue model. It's called Interchange. Every time you swipe your debit card to buy a coffee, the merchant pays a small fee, usually around 1 to 2%, to process that transaction. Neobanks take a cut of that fee. Because they don't have thousands of expensive physical branches to pay for, no rent, no utilities, fewer tellers, they can afford to operate on just that interchange revenue. They pass the savings back to you as fee-free banking. It's a volume game. They need millions of users swiping millions of times to make the math work. Neobanks didn't just compete on price, they competed on features. First, early direct deposit. They realized that banks usually sit on your paycheck for a day or two to earn interest. Neobanks said, here, take it immediately. Getting paid on Wednesday instead of Friday became a huge selling point. Second, automated savings. Apps like Chime offer roundups. Spend $4.50 on a latte and it automatically rounds up to $5, moving 50 cents into savings. It sounds small, but it adds up without you thinking about it. Third, instant freeze. Lost your card? Tap a button in the app to freeze it instantly. Found it under the couch? Unfreeze it. No calling a 1-800 number and waiting on hold. But here's the big question. Is your money safe in an app? Most neobanks aren't actually banks, they're technology companies. Read the fine print and you'll see banking services provided by the Bancorp Bank or Stride Bank. They partner with traditional chartered banks to hold your money. This is crucial because it means your deposits are still FDIC insured up to $250,000. If the app goes bust, the government still protects your cash. So, should you switch to a neobank? The benefit. If you live paycheck to paycheck, the early direct deposit and no overdraft fees features are life-changing. Saving $300 a year in fees is real money in your pocket. Plus, the apps are just better. The risk. Customer service hell. But here's the trade-off. Neobanks are tech companies, not service companies. If their algorithm flags your account for suspicious activity, even by mistake, your account gets frozen. You can't walk into a branch to fix it. You can't call a local manager. You're at the mercy of email support. People have been locked out of their rent money for weeks with no one to talk to. The limitation. Also, try depositing $5,000 in cash. You can't. You have to go to a 7-Eleven or CVS and pay a fee to load cash onto your card. And good luck getting a cashier's check for a down payment on a house. The bottom line. Neobanks are fantastic as a secondary spending account, but for your life savings, you might still want a brick-and-mortar bank as a backup. Neobanks have forced the big guys to adapt. Chase, Wells Fargo, and Bank of America are all launching better apps and cutting fees to compete. The winner? You. Next time on FinBytes, we're diving into insurtech, how companies like Lemonade are using AI to pay claims in 3 seconds flat. Subscribe to FinBytes for more digestible fintech insights. See you next time.